Hi everyone, I am Roger Herring. I am the founder and CEO of Investors Accounting LLC, and I want to welcome you to the first segment of our brand new thing. We're calling this Ask Roger. This is your opportunity to ask me a real estate question. And if you want to submit questions, you can inbox me at Facebook or send an email to info@investorsaccounting.com. We'll go ahead and we'll put those links up in the description for you. So, our first letter comes from Bob in Chicago, Illinois. Shout out to Bob and his wife. Bob writes, "My wife and I have 7 rentals." Well, congratulations on that. They all cash flow, but because of our income, we are not able to take any real estate losses. I work full-time. My wife is a self-employed consultant. So we don't qualify as real estate professionals because we don't spend enough time in real estate versus our regular jobs. Is there any way that we can take some of this deduction now as a benefit, or are we just stuck? Well, Bob, I got some good news for you. There is a way because of your circumstances. Let me explain this for everyone. Bob's first problem is that he has trapped losses. Why does Bob have trapped losses? Let's go to the board and let me explain it to you. You see, anybody that actively manages their rental properties, they can take up to $25,000 of passive loss from rental real estate. Now, we don't want these to be real losses. These are what we call the phantom loss, which is created by depreciation. So our properties cash flow, but on paper, for taxes, they throw off a loss. Now, the law says he can take $25,000 until the adjusted gross income equals 100K. All right, that's the problem. His wife and Bob, they are phased out because for every dollar over, they lose 50 cents of this maximum deduction. So as they go to 150,000, this deduction drops and they are totally phased out unless they can qualify as a real estate professional. Now, what's a real estate pro? It's not about a license, it's about time. Real estate pro must spend 750 hours in real estate as an owner's capacity. That's easy. Here's the other one. More than 1/2 of your for-profit time has to be spent in real estate. Okay? Bob and his wife work. They can't qualify. But here's the saving grace. You see, this $25,000 is offsetting ordinary income. The law says our rental losses can offset passive income. So we have to create some passive income. How are we going to do it? Well, quite easy in this case. Because Bob's wife is self-employed. So what we're going to do is change the nature of her business. Instead of being an S-corp or a sole proprietorship, we're going to make Bob a partner. But Bob is going to be a limited partner. The wife is the general partner. She still has self-employment taxes. But Bob, there's no self-employment tax because he's passive. And here's something even better. Because Bob is passive, that passive income can absorb the losses from the rental real estate. And here's what's even better. If there's loss or if there's income left over after this year's rental losses, he can recapture previous years and bring that income to zero. So Bob, the answer is we've got to convert some of your ordinary income into passive income. Hey, you know, I've got a seminar coming up on the 14th of June, and this type of strategy is exactly what we're going to be talking about. It's at the 1818 Club in Duluth, Georgia. The investment's only $50, and hey, I'm going to buy you breakfast. So come on out and see me. Remember, you can submit questions by inboxing me or sending them to info@investorsaccounting.com. Until the next time, Roger out.